We've got with us Arnab Das of Das Capital joining in on the show. Arnab, hi, afternoon. Good to have you on the show as always. Finally, Fed's bit the bullet, but no end point has been given this time around. How do you see the tapering timeline to go? Would it be fair to assume that the Fed is going to reduce easing each time by $10 billion?
Well, I think as Chairman Bernanke indicated, the whole process is going to be data dependent, and I think the verbiage was very dovish. I think in particular the Fed succeeded in making two distinctions: one between tapering and tightening, which it had been trying to do ever since the taper tantrum last year. And second, a distinction between what people thought of last year as tapering being an on-off switch for QE to tapering being a dial, right? So now I think the market believes that this is all data dependent, and if the economy turns, the U.S. economy in particular, turns south a bit as a result of the tapering, then the tapering will be slowed down, or even quantitative easing will be dialed back up a bit. I don't think that'll be necessary because I think a number of the headwinds for the U.S. economy in recent years have been removed or at least significantly delayed. Right, next year there'll be less fiscal drag, and the tail risks of fiscal uncertainty, debt ceiling, default, all these kinds of things in the U.S., and the tail risk of the Eurozone crisis, these have all been substantially reduced or suppressed or even removed. So I think things are going to improve, and then over the course of 2014, there'll be more tapering to come. I think in quite judicious, discrete, and modest elements or bits and pieces, such as the one that was announced yesterday. Right. So I think this is pretty good for risk assets in the short term, and I think most markets around the world are responding accordingly.
Right. But Arnab, so just to pick up the point that you made earlier, then do you think markets now are convinced that tapering is not tightening? And if you see how European markets have opened right now, it's been a pretty strong open in Europe as well. So in a sense, do you think markets are convinced about that?
Yes, I think I think this the guidance, the forward guidance on rates on Fed funds was particularly dovish, right? And there was a kind of a signal that has been building for a while and now is somewhat more official, that the FOMC will be willing to see the path of unemployment go significantly or at least meaningfully below previous thresholds before tapering advances a lot, and indeed before rates start to go up. So I think we have kind of an asymmetric situation in which the Fed will not taper or tighten until the economy is clearly doing very well. And on the other hand, if the economy seems not to be doing so well, then tapering will continue at the current pace or even be slowed down. Right? So it's really although many people had been expecting tapering to come later rather than sooner, including myself, I thought January rather than December. The tapering has come sooner, but the dovishness around the taper has been so strong that people are convinced that they don't need to worry so much about the Fed.
Arnab, what about India then? And how have you read into the RBI's pause policy yesterday? And would you say that was the right thing to do, or was the RBI behind the curve?
I think the RBI under Rajan has been doing, broadly speaking, the right thing to manage the situation in the short term. And I think that's very good because conditions could have been significantly worse. But I think there are two elements that are beyond the RBI's control that are both positive and negative. One we've just been talking about, which is the Fed. I mean, really, India and many other central banks, RBI and many other central banks in emerging markets that were caught off guard or at least wrong-footed by the Fed last year, during the middle of last year, have had a pretty good third, fourth quarter. Sorry, I say last year, this year, have had a pretty good fourth quarter in particular because the tapering was taken off the table in September, and now the tapering is dovish. So in a certain sense, it's been at least as much, if not much more, about the Fed than about individual central banks in emerging markets. And then the second thing I would say is that all of this is about financing. right? What the RBI has been doing is a combination of administrative measures and policy measures, macro and sort of macro or even micro-prudential measures that have helped to mitigate the current account deficit. But the real issue in India, as ever, is structural and political. And the jury, of course, remains out on that, and all the hopes are there for the election next year. We'll see how much can be delivered. I think the real issue here in the case of India is not about managing this turbulence, right? This is small beer because it's such a dovish process. Really, the underlying issue is that the imbalances in the Indian economy remain, the bottlenecks remain, the rigidities remain, and it really requires a concerted political effort on all sides for the federal government to kind of replicate a lot of the successes that have taken place at a state and local level for the country as a whole, and thereby improve the growth dynamics, raise the potential growth rate back up, and ensure that growth doesn't run into inflationary bottlenecks. Now, making the RBI somewhat stronger and more independent and more focused on inflation, that's great, right, and absolutely necessary, but it is far from sufficient. And the political side now needs to deliver. Otherwise, the imbalances will continue, and when the Fed eventually does taper, possibly tighten, when the Fed moves from tapering to tightening, maybe 2015 or 2016 or earlier, if the U.S. economy does better, then India will be in trouble.
Right. But Arnab, just to talk more about the Fed move and its impact on emerging markets, like you said, we haven't seen the kind of panic reaction that we saw when Bernanke first spoke about tapering. But what is your sense? Because, you did outline some of the fundamental problems that an emerging market like India faces. Do you think this is just a calm before the storm? Because, when easy money moves out of EMs, that is going to have some sort of an impact on equities as well and currency as well.
Yeah, I think it really depends on whether India and the other, fragile five or the sickly six or however many you want to look at really deal with their structural problems. And I think, like I say, that's an open question. I would tend to think that most countries in emerging markets, including India, will end up disappointing on that front. Even though there will be some progress, there won't be enough to insulate the balance sheets in emerging markets as a whole, and India in particular, from an eventual change in global financial conditions, right? Now, we're in a pretty good period because the recovery in the U.S. continues. There's a kind of weak but at least incipient recovery in Europe, and Japan is, by all accounts, doing fairly well. But the developed world has not solved most of its problems. It's papered over the cracks with easy money. And, the U.S. has done more than most other countries, but it hasn't done enough. Europe is making progress on the economic front. The cycle is moving in the right direction. But recent weakness in France shows how tentative and fragile and uneven, to use Draghi's words, the recovery there has been. Now, there's progress on banking union, but really, there's no full-scale deepening and cohesion in the monetary union that's being created, right? The problems between the north and the south of Europe remain in one way or another. And Abenomics in Japan, the monetary side is going very well, but hopes are starting to wane on the structural side. And therefore, even though Japan is doing cyclically quite well now, potential growth and the debt dynamics and those kinds of issues will remain a concern. So the developed world, some things are good, some things are bad. Now, those things being bad, they're going to keep monetary policy from tightening very much, and that's going to give a lot of breathing space for emerging market countries, including India, to let their political problems and structural and institutional issues stand in the way of a very strong reform process. Right? Nobody really does these tough things except under the pressure of a crisis. And easy money mitigates that pressure, right? So we're in this kind of ironic situation, I would say, in which we have support lest we go over the edge of deflation or something worse from the monetary side. But that is creating a perverse kind of moral hazard where we're not dealing with our structural issues. That's true in the West, it's true in Japan, and I think it's true in emerging markets as well.